Hi, I'm Jeff Colton, and welcome to Unit 9. This week we examine capital investment decisions. This follows on from our analysis in the last unit of generating a profit plan and a cash budget. As part of their overall budgeting process, managers periodically make decisions about long-term investment for new projects or replacement of old assets. These sorts of decisions focus on creating long-term value consistent with organisational strategies. Since these decisions involve cash flows over a number of years, taking into account the time value of money becomes important. Capital expenditure decisions can involve questions about whether to acquire new property, plant and equipment or to upgrade existing equipment. So a bike manufacturer from a few weeks ago, Baum, could be considering whether to continue renting their warehouse or to purchase a new warehouse or to upgrade their welding and painting equipment. Firms should try to take a systematic approach to these types of decisions. Here's one workflow. First, identify alternative decisions, for example, to develop or expand products or services. Next, we identify the relevant cash flows. Third, we apply one or more quantitative analysis techniques. We'll be going through the following techniques in our class: net present value, or NPV, internal rate of return, or IRR, the payback period, and the accounting rate of return. You would typically then undertake some sort of what-if or sensitivity analysis. We know that it is hard to forecast future cash flows with certainty, so getting a sense of how sensitive your analysis is to change in expected future cash flows is an important part of project evaluation. You would then consider the quantitative and qualitative information you need to make a decision. Finally, it's always important to evaluate a project after it is completed. This may be a year or even longer after a project is implemented, and may include an evaluation of the accuracy of the initial plans and cash flow estimates, and progress reports on the outcomes of the project in operational and financial terms. Capital budgeting projects are often evaluated as if they were standalone. However, as managers, you may well face capital constraints, so that accepting one project would eliminate another. Cash flows for alternative options in capital budgeting typically vary over the proposed investment period, and even the investment period itself can vary between options. One way we take this into account is to discount all cash flows back to their present value, or their value in dollars today. This takes into account the time value of money, the notion that you would probably prefer to have $100 today than $100 at some point in the future. Using a discounted cash flow analysis makes these cash flows equivalent to cash flows in the current year. To get cash flows into today's dollars, you need to select the discount rate, that is, the rate that converts future cash flows into current cash flows. This is also known as the required rate of return, or the hurdle rate. Selecting a hurdle rate is a non-trivial exercise. Many firms use the weighted average cost of capital for their whole firm, that is, the cost of debt and equity. However, this ignores variation in risk among projects. Riskier projects could be assigned a higher discount rate, which means that future cash flows are worth relatively less in dollars today. A net present value, or NPV, calculation takes the cash outflows and inflows from a project and converts them into present values using that discount rate. Firms will look for investments that provide positive expected net present values. An alternative evaluation method that still relies on the notion of the time value of money is the internal rate of return, or IRR. In this method, we forecast the cash inflows and outflows from a project and calculate the discount rate that provides a present value of 0. Another way to think about this is for the IRR is the discount rate that makes the net present value of the cash inflows equal to the initial investment in a project. Managers will then compare the IRR of a project with the rate of return being generated on current projects, or a required rate. Apart from financial impacts, There can also be strategic considerations for investment decisions. These can involve non-financial or qualitative information. Increasingly, information about sustainability goals are becoming important considerations for organisations, such as ESG or environmental, social and governance. Firms also consider the cost of reversing a decision. They consider monitoring costs as well as regulatory and reputation risks of projects. So it's not always about the dollars.